All right, so safe as houses, what's going on with the Australian property market? Well, it's been exciting to be watching it from afar. Let's get into it here. Of course, no financial advisor presentation would be complete without the standard disclosures here, and that is, this is not specific advice. This is general commentary about what's going on. I'd encourage you to retain a professional, be they a financial advisor, a CPA, tax attorney, on your particular circumstances. So with that in mind, a little bit about me. I'm tri-citizen, born in the UK to an Australian father, raised in Australia with an American mother. So when someone asks where I'm from, I say Australia. I was really there from 3 or 4 months of age till I was 23, moved to the San Francisco Bay Area to seek out the bright lights of the big city and follow my dreams there. After finishing studies at UQ, saw the light 2008, which was a heck of a time to be making a career transition to becoming a financial advisor. But that's when I swapped over, started the CFP, CFA study. And what really gave me inspiration to work in this particular niche that I'm in, working with Aussie expats, is when I came over, there was nothing. There were no resources, there were no advisors, there was no websites, no books, nothing to assist Aussie expats really plant their feet firmly on the ground and help them make sense of the decisions that were to be made between the two countries here. So anyway, that's a little bit about my background. Moving on here, Arete Wealth Group really consists of two different entities, one of which is Arete Wealth Strategists, focused on US business owners. So I keep myself sharp working with domestic clients, and I am first and foremostly a US registered investment advisor with a global network of service providers that I pull in where needed to assist with my clients. But some attributes that are common between these two brands would include, we're fee only. We don't accept commissions from anyone at any time. Therefore, well, not therefore, but also, we are a fiduciary acting in our clients' best interests all of the time. We're paperless and digital, virtual and in person. Just got back from New York 2 weeks ago and San Francisco last week. We're seeing clients and attending conferences. That's another thing, actually. It's not on the bullet point list here, but typically I would attain 3 or 4 times the required continuing ed for my particular designation. So I love the space that I'm in. I love what I do, and it's a privilege to work with the clients that I work with. All right, so with all that said, where have we come from and where are we right now in this real estate business cycle? What's happened? We point to 5 factors. We look at the Australian economy slowing down, which is in turn a knock-on effect perhaps of what's going on elsewhere in the world. Housing affordability becoming a key political issue. Foreign buyers becoming a little cautious about what's going on, perhaps driven by that political issue. Mortgage underwriting changes, courtesy of the regulators. A crackdown on non-resident investors with all sorts of exemptions and taxes disappearing or increasing. Then we'll be reviewing those particular items in a little more detail here, given the challenges facing Aussie real estate investment for non-residents. Talking about the general issues, could be any asset that you own as a non-resident. Here are the common issues. Mortgage underwriting issues, so what are the particular hurdles facing non-residents? Australian tax issues, and of course the US tax issues. But this is really what sets the stage for tonight's presentation. What you can see here is since the year 2000, more than a tripling in the median home price in Australia to the end of 2017. Quite a substantial performance. It's very interesting living here in the United States in the middle of what was a boom in the 2000s leading up to that housing crisis, and now looking at where Australia has come. And I'm not foreshadowing any major correction. That's not where I'm coming from. But to see how far Australian real estate has come in terms of affordability and average rents is really remarkable when you compare it to the United States. So what we've seen, what initially kicked off this, without going to the dawn of time, what initially kicked this this trend off was the first homeowners grant, growing from 7,000 all the way up to 21,000 as it eventually took hold. I should mention, by the way, that point just reminded me, we will shortly be releasing a very well-researched article on tonight's presentation, and you can go there for further references. So we had an export economy that really kicked into overdrive in the mid to late 90s as Australia became one of the primary producers of resources that powered the industrialization of the global economy. We saw an abundance of interest-only loans and very lax standards relative to Australian standards, that is, on the issuing of interest-only loans. And of course, the controversy surrounding negative gearing continues. Just for clarification, how does that exist in the United States? Well, it doesn't quite exist in the same way. If you have a loss on your investment property, that's really called a passive activity loss that you're only able to recapture inside of another passive activity. It's not a loss that you could generally take against your ordinary income. So that's just a little point of clarity there. The impact of foreign investors, of course, with a globally booming economy, we see investors from all over the world trying to find safe haven in a stable political and growing economy such as Australia. And as we see here, different statistics say different things. We've seen up to as high as 20% of new home purchases at its peak in 2016 were from foreign purchases. Now here's where we are now. This is just based on Sydney. From its peak in July of 2017, we've seen a decline of 12% to the end of 2018. We don't have more recent data than that. But in the fourth quarter of 2018, perhaps a bit of momentum is being picked up with a decline of 4.5%. So what's behind this? Well, we think it's actually a fairly well-regulated application of the brakes that APRA, Australian Prudential Regulatory Authority, is applying in changing the mortgage underwriting standards. So they've decreased the amount of interest-only loans that they're comfortable seeing down from 40% to 30%. They've since relaxed that. That's gone away, but that was a factor that perhaps kicked this off as investors have gone from paying simply interest-only loans to principal and interest. And anyone that has seen or heard of that happening knows that we're talking about a tripling or quadrupling of someone's monthly payment depending on that amortization schedule. And also they crack down on loans to investors as well. So that perhaps is what got the ball rolling, aside from the other taxes and fees and so forth that we'll get to shortly. So what happened? Here are the 5 issues, as you heard me outline at the commencement of the presentation here. Housing affordability as a key political issue. Reduced foreign buyer activity, regulators applying the brakes, dependence on the Chinese economy, and a crackdown on non-resident investors. So housing affordability. I was speaking with my dad earlier just to get an interesting point here to set the stage for what housing affordability was like. And I called my father and I said, Dad, what did a home cost? What was your first home? How much did that cost and how much were you making at the time? He said, well, I remember that just like yesterday. It helps that my father was a real estate economist, of course. He paid $7,500 for his first home in Brisbane. He coincidentally was from Sydney, but moved to Brisbane. So $7,500 is what he paid. And between my mother and my dad, they were making $5,000 back in 1970. So we're looking at a ratio of 1.5. 1.5, and this is where it's gotten to 12.9 in Sydney, 9.9 in Melbourne in 2017. To put that in a global perspective, there's only 2 places in the world that were worse on that particular front. So what we're seeing as many first homeowners and younger buyers are simply priced out of the market, we're seeing a proportion of renters increase out there in Sydney and Melbourne, which is, of course, largest markets and where most of these statistics can be found. Reduced foreign buyer activity, primarily from China. It has decreased significantly for various reasons. We'll be talking about the softness in their own economy as being a factor in just a moment. But as you heard me say, the statistics do vary a little bit as to exactly what percentage accounted for new housing demand. But we see a different stat there, 15 to 25%, and state governments introducing all sorts of stamp duties and land tax surcharges and ghost taxes and all sorts of things to discourage foreign buyer activity so as to make it more affordable for domestic residents. Regulators applying the brakes. So we've seen the Reserve Bank of Australia hold interest rates. I'm referring to an incident that occurred in 2018. The RBA decided to keep rates level. That didn't stop the big four banks that have an oligopoly on the Australian market from passing on a rate increase of their own in a coordinated fashion. So separately from that aside, they've also made it a little bit more difficult for non-resident investors to obtain a loan in the first place. One of the ways would be an increase in the loan to valuation ratio, meaning you need a higher deposit. So instead of requiring 20, you might require as much as 40%. In addition to a higher interest rate applying for a non-resident investor, there's also the decrease in the amount of interest-only loans that APRA is comfortable with. So we feel pretty comfortable that the regulator is well on top of what's going on there, and for various other legal reasons. I'm thinking specifically of the lack of non-recourse debt, i.e. recourse debt in Australia, meaning you simply can't mail the bank your keys if you have negative equity in your property and just walk away from the property. They will be coming after you to recover what they are owed, which is great because it puts a floor under where that market's likely to go, because people have they really do have skin in the game. Next slide here, dependence on the Chinese economy. I'm not picking on China and their non-resident investors. This slide is about a different point altogether. It's actually about the impact on Australia. You can see that China is far and away the most significant trading partner that Australia has. Therefore, if China slows down, what's going to happen to Australia? There's going to be all kinds of knock-on effects in terms of its buying power, the health of its consumers, and what they're able to afford. Never mind the health of the Chinese investor, the Chinese non-resident real estate investor, and what they might be buying in Australia. So what sort of downside are pundits predicting? Well, depending on what source you reference, we're seeing declines in major cities from 10 to 25%. When were those forecasts made? Well, we're looking at those towards the end of last year, so some of that decline is already baked in. But as you've heard me say, this is not an alarmist presentation at all. We're not expecting any US-style crash by any means. We're talking about a moderation here. We think the health of the market is still quite favorable in Australia, and we think that this has mostly been purposely induced for political reasons back in Australia. Obviously not the economic side of things. Australia's hardly seeking any slowdown in China, but we're talking about the moves APRA's made, the various states have made, and so forth. Nevertheless, no one can predict the future, and we would say some tail risks that exist would be perhaps an over-application of the brakes, perhaps raising interest rates. There's no talk of that happening, but perhaps if this main residence exemption does end up going through, apparently there's scuttlebutt saying that it won't, but if it did, then that could be another negative factor weighing on the housing market, or of course a trade war between China and the US. There hasn't been a great deal of talk about that in the past month that we've been following that issue. I want to come back. I really, really want to emphasize this point here, the headwind facing non-resident investors in Australian real estate. I don't think this was sufficiently conveyed in the last webinar that I did on this in April of last year. I want to be real. I want to be really clear about this. There's nothing here that's positive. There's absolutely nothing here that's positive. And the only reason someone would think about buying there that I can make sense of is if they were planning on moving there in the very near future. But let's review these factors just to be sure. Okay, for all the reasons we've just looked at, it's one of the most unaffordable and overvalued markets in the world. In the world. There's no asset class that I would ever recommend a client go into when we're seeing these sorts of statistics. Okay, another factor, foreign exchange issues. Look at what's been going on with the Aussie dollar in the past 12 months. We've been seeing it decline from 73, briefly touch 69 cents for a fraction of a trading day. It's now back around 70. So the rent or whatever return you're receiving has been declining because repatriating that money back to the US, it's worth less. You know, who knows what the future may hold for that. And I'm pleased to say that for the first time in the coming quarter's newsletter, we actually have professional opinion there from a foreign exchange partner with a 12-month forecast of the Aussie-US dollar pairwise trading relationship. Property management, Australian tax filings. So now you have to worry, as a non-resident property owner, you have to worry about property management, dealing with tenant issues. Well, maybe that's not an issue. Pay 8% of your rent, and you can hire a company to deal with that for you. But you'll also have to deal with Australian tax filings, never mind the US side of it, which we'll get to in just a moment. So you've now brought yourself back into the Australian tax system where you didn't need to be in the first place. Mortgage underwriting for non-residents. We reviewed this briefly on a former slide. They're not recognizing all of your income because they don't necessarily believe it's all legitimate. Likely a higher interest rate as a non-investor, as a non-resident investor. We can see that here really quickly. I didn't want to do too many of these other web pages. Look at that in bright red there. This is from Home Loan Experts, they're not making money by scaring you out of it. They're just saying that's what to expect as a foreign citizen. Now, not everyone viewing this is a foreign citizen, but the point is that there's headwind facing non-resident investors. Now, here is a great list of reasons from the Australian perspective, from the Australian tax perspective, that make it difficult to make a profit owning investment real estate in Australia. Okay, the long-term capital gains exemption for non-residents, that went away in 2012. So you're talking about paying these kinds of non-resident rates from the first dollar of income or from capital gains right here, 32.5% up to $18,200. Above that, it stays at 32.5. Up to 90,000 when it graduates to 37, and then to 45 plus the Medicare levy. Really, really high rates of tax. Let's be clear about that. Okay. That's if you're to sell or if you have income. Some people get clever and they say, oh, no, I'm contributing that to my superannuation account. Well, pretty good move. I would refer you to my webinar on how the IRS treats superannuation accounts, because you might be too clever by half in having that idea. Income tax, non-resident rates, as you heard me say, so there's no long-term capital gains exemption. Your income is taxed at non-resident rates. There's higher land tax rates, as everyone said growing up, for absentee owners, is specifically in Queensland, higher stamp duty for non-residents, ghost house taxes. Why is that? Because of a capital gains exemption that exists or existed for properties that weren't rented as investment properties. So therefore, if you don't rent it, if it's not occupied for more than 183 days of the year, then you cop another tax. You cop the ghost house tax. Travel expenses. Wouldn't it be nice to take a tax-deductible trip back to Australia to investigate or have a look at your investment property? Well, that's no longer allowed either. And let's keep in mind, the US applies asymmetric treatment of foreign exchange related gains and losses. So losses are not tax deductible, gains are taxable as ordinary income, not as long-term capital gains, as ordinary income. So you can't take a loss, but you do have to pay tax on a gain. keep in mind that the tax treaties that exist, while you might not be double taxed, emphasis, not be double taxed on the income from, should you have any at all, I should mention, should there be any income to report whatsoever on an Australian investment property, it is, depending on what state you live in, most Aussie expats live in California and New York. The residents of those states are subject to state income taxes, and that income forms part of your state assessable income. So rarely have I encountered such a comprehensive list of reasons to consider not investing in a particular asset class. So here are your options. Something happened there with the hold. You could buy, hold, or sell. It's no different to any other asset. So buy, not sure quite exactly what that case would be, unless you were looking to move there imminently. And then my question would be, well, why not just wait till you get there and inspect the property firsthand? What is there to lose, presumably in a declining market, should that continue? What's there to lose by waiting and inspecting it firsthand? Hold. What are the two scenarios where it might make sense? Well, if you're expecting a medium-term recovery in, say, the next 3 to 5 years, and you're nursing a larger loss and you expect it to get back to even, okay, maybe that makes sense. Or if you see yourself returning to Australia in the long term, and you've got a property with big embedded gains that you don't want to crystallize or realize that loss, then perhaps it would make sense to hold on to that. Otherwise, I think the strongest argument is to be made for the case to sell or not enter in the first place, given the headwind that we see there and the disadvantages facing non-resident property owners. I think since it's been a year since the original webinar on this topic was hosted, I would say the reason why people avoid selling is because, avoid selling is because of an unfamiliarity with other asset classes. That's simply what it boils down to. Property is tangible, it's real, you can drive around there, sit on your lawn, you understand what's going into that, what the drivers of that property are, your tenants perhaps, and it feels good. And I would say that if you compare the returns of other asset classes, I'm thinking equities in particular, over, say, the last 10 years, despite the phenomenal growth that we've seen here in the real estate market, the returns in the stock market have been even greater. It's just that, and please, I'm going to have this written on my tombstone someday, it's because people don't compare real estate investment to a stock market investment in an apples to apples comparison. Investors typically greatly leverage their real estate investments, don't greatly leverage their stock investments, and then compare returns as if they're comparing apples with apples. So I would just make that point about equity investing. Arete downloads, please go to arete-wa.com. You'll find we've produced what I believe is the only key financial data sheet for Aussie expats living in the United States. So on the front side, we've got the key financial data for Americans, and on the back side, we've got key financial data for Australian facts. And up here, you can see there's ordinary income rates right there. Back to present. We've got a number of white papers in production. How passive foreign investment corporations affect Aussie expats. Aussie expats, how will your Aussie property be taxed now that you're a US tax resident? That's coming very soon, as is I want to prove to you, because I will admit these have been slow to come out, but we can see right here we have a 10-page, very well researched article that is soon to be coming out on tonight's presentation that I encourage you to look at in further detail. How do I learn more? Well, please go to our website, schedule a complimentary 15-minute appointment. We provide the greatest value, I think, to long-term residents, long-term Aussie expat residents living in the United States or higher income earners with complex situations that could use professional advice. Thank you very much for your attendance here tonight. And I'm going to do something I haven't done before and take a couple of questions. I'll do my best to answer them. But if you need expert advice, then we work with clients and do our best to satisfy them and their financial needs. So thank you very much for attending. Do I hear any questions out there? Please chat them in. All right, I'm just waiting for any questions to come through, see if anyone has any questions related to the state of Australia's real estate market. We'll give that another 20 seconds or so for questions, and then we'll call it a night. All right, not seeing anything coming through there, but want to thank you all very much for coming here tonight. It's been a pleasure speaking with you, and look forward to hosting our next webinar. Next webinar topic is best practices on foreign exchange. All right, thank you very much. Have a good night.